Before we start this video, do like and subscribe to our channel and not miss on any updates.
My dear friends, before we proceed to next interesting point, let's once quickly revise all the sections what we have done till now and then proceed. So guys, what is section 27? 27 defines who is an assessee. 29 assessment year. 224 income. 225A India. 231 person. 234 previous year. Section 3 is also previous year. Section 4 chargeability section. And how many exceptions are there to section 4, my dear friends? 5 exceptions are there. Section 172, 174, 174A, 175, 176. Clear, my dear friends? Exactly. So now, without any delay, let's proceed to discussion about some very interesting tax rates what we have got in this first topic of basic concepts. As I already told you, my dear friends, when I talk about these tax rates, some tax rates are given in the Income Tax Act itself, whereas some tax rates are given by the Finance Act. Now, the point to be noted very clearly is that when I am telling you that some tax rates are given in the Income Tax Act itself, that means for the tax rates given in the Income Tax Act itself, we will find section number. But for the tax rates given by Finance Act, we don't have any section number as such. So first let's look at what are the interesting special tax rates given in the Act itself. Then we look at the normal progressive tax rates given by Finance Act. And after that, we can discuss some interesting questions as to how do we calculate the tax. Come on guys, listen now carefully. First, so friends, when I talk about these tax rates, first let me tell you some interesting special rates of tax given in the Act itself, that is Income Tax Act itself. First, let's talk about the first interesting rate, tax rate we are going to learn is, now let's say for a second, one person, Mr. A, he purchased one lottery ticket and unexpectedly, and he didn't even imagine, suddenly he got lottery prize money of 10 lakh rupees. Now first question to you, do you think he is happy? Definitely answer is yes. But along with him, let me also tell you that Income Tax Department is also very happy that he got lottery, because lottery incomes are taxable at a flat rate of 30%. You might get one doubt, sir, why did you say flat rate? The reason because I am saying flat rate because from that lottery income, we cannot reduce any expenditures, we cannot reduce any losses. You cannot tell 10 lakhs is the lottery income what I got, but to buy the lottery ticket, to go there and come back, I incur different cost of 1 lakh. You can't reduce that. Law is telling please pay tax directly on 10 lakhs only. So my dear friends, let me highlight section number here now. There is an interesting section number known as section 115 BB, capital B, section 115 BB, which specifies that in case of income from betting, winnings from betting, gambling, lotteries, crossword puzzles, something like Sudoku, or card games, or horse races, or any other games of any sort. Now you cannot tell, sir, Virat Kohli is playing cricket match, will it come under this category? No, that's a clear-cut sport. We are talking about betting, gambling, lottery, or winnings from any games, or horse race, or Sudoku games. That kind of thing is what we are talking about. Not playing sports. They are all professionals. They are all professionals. That is why this kind of incomes is called casual incomes. Casually we got it. Income from betting, gambling, lottery, crossword puzzles, card games, horse races, or any other games of any sort. Law is telling straight away pay tax at the rate of 30%. So for example, one person has played card games and in that card games, he has got 5 lakh rupees. Law is telling on 5 lakhs, straight away 30%, 1,50,000 paid tax to the government. So section 115 BB specifies that winning from betting, gambling, lotteries, crossword puzzles, card games, or any other games of any sort related to this kind of casual incomes will be taxable at a flat rate of 30%. I'm sure this concept is clear for all of us, my dear friends. So when now don't get one doubt thinking that, sir, it is illegal. No, sir. Betting, gambling is illegal. No, sir. I already told you one point. Income tax is not concerned with legality. They are concerned only about taxability. And it is not that every place this betting gambling is illegal. There are some states and some places where betting gambling is legally allowed. Something like casino, it's legally allowed. You're getting my point, my dear friends? So section 115BB specifies that income from betting, gambling, lottery, crossword puzzles, card games or any other games of any sort, including horse races and all, straightaway income is taxed at a flat rate of 30%. So the first tax rate what we discussed is section 115BB, where the tax rate is flat 30% in case of winning from any betting, gambling, lotteries, crossword puzzles, card games, horse races or any other games of any sort, then the tax rate is straightaway flat 30%. I'm sure we are clear with that point, my dear friends. Exactly. Next point, my dear students, listen very clearly. Now, sir, let us say income tax department suddenly conducted income tax raid in the house of, let us say, one person, Mr. Akash. In the house of Mr. Akash, income tax department has conducted income tax raid. Now, when they conducted income tax raid, they found lot of money and they found lot of gold. They found lot of documents which clearly shows that he made so many investments. And income tax department questioned him saying that all these details are not available with income tax because you never submitted these details to income tax. So according to us, we all know that local language what we use, something called black money. Black money is not illegal money. Black money is unaccounted money. Illegal money is money earned through illegal activities. Black money is where money is earned legally, but tax is not paid. That is why we call that word as black money. So next point, my dear friends, listen very clearly here. So in Akash house, they found lot of gold, cash and also other articles there, which was not accounted, on which he never paid tax, and the source of income was never submitted to the income tax department. And income tax questioned him, what is the source of this particular articles or money or jewelry or investments? And the person Akash could not offer a satisfactory explanation where from he got all this gold, cash and money. Then law is telling, if it is not explained properly, if satisfactory explanation is not given to the assessing officer, then all this will be taxed at a flat rate of 60%. Plus, there is also something called a surcharge. Surcharge is something like additional tax which is calculated on the tax, and the surcharge rate is 25%. Apart from that, there is also something called health and education cess at the rate of 4% on the tax, which is mandatory to be paid by everybody who is paying income tax. Shivateja also is paying income tax along with health and education cess. 60% plus surcharge 25% plus cess, health and education cess, which government is using that money for promoting health and education in India. That is why it is called health and education cess. Cess is nothing but a tax which is collected by the government and used for a specific purpose. Cess is nothing but a tax collected by the government and used for specific purpose is known as cess, health and education cess. In short, we call it as HEC. So basic tax rate is 60% plus surcharge 25% plus cess 4%. Our brain will tell 60 plus 25 plus 4, sir, total is 89%, sir. Answer is no. The total is only, effective rate is only 78%. You might get one doubt. Sir, how 78% has come? The reason because 25% is calculated on 60%. 25% of 60% is 15 and 60 plus 15 total is 75, and this 4% is calculated on 75. 4% on 75, 4% on 75% is nothing but 3%. 75% plus 3% will work out to 78%. You are getting my working, my dear friends? So in simple terms, what I am trying to tell you is that surcharge is computed as a percentage of tax. Surcharge is computed as a percentage of tax. HEC is computed as a percentage of tax plus surcharge. I repeat again, surcharge is computed as a percentage on tax. HEC, that is Health and Education Cess, is computed as a percentage of tax plus surcharge. Now, in which all cases this 60% plus 25% plus 4% effective rate 78% will come into picture. In all the following cases, this 78% story will come. Case number 1, unexplained cash credits. That means in the books of accounts there is some income, or in the bank there is some credits in the bank, but the assessee is not able to explain the proper source of that particular cash credit. Unexplained cash credit, unexplained money, jewelry, bullion, unexplained money, jewelry, bullion. Next, unexplained investments. He purchased some property, but if he is asking source of income, from where you got money to buy the property, he is not able to tell. You're getting my point? It is not so easy to just like that escape income tax and do whatever you want. One fine day, by one transaction or the other, income tax will catch hold. So first point is what? Unexplained cash credit, unexplained money and bullion and gold. Next, unexplained investments, unexplained investments. Next, unexplained expenditures. He made payment of 10 lakhs to somebody, incurred some expenditure. The assessing officer is asking assessee for what purpose you incurred. He is not able to properly explain the reason for that expenditure. Unexplained expenditure. So what are the points we have done? Unexplained cash credits, unexplained money, bullion, gold, then unexplained investments, unexplained expenditure. Next point, investment is not fully recorded. When I say investment is not fully recorded, that means he purchased a property for 10 crore, but in books of accounts, he is showing only the value as 3 crores. Then officer is asking, where from you got balance 7 crores to buy this property? Explain. Explain the source of money for this investment. If you don't explain, tax at the rate of 60%, surcharge 25%, HEC 4%, effective rate 78% is gone, and this is only tax. Interest is separate, penalty is separate. Oh my God, you're getting the point, my dear friends. 78% is only the tax component. Interest is separate, penalty is separate. So what are all the points covered in this 78% story, my dear friends? And let me tell you the point. This 78% concept and story is given by section 115 BBE. 115 BBE says in the following cases the tax rate is 60% plus surcharge plus cess. And surcharge is 25% in this case. So effective rate is 78%. And what are all covered here? Unexplained cash credit, unexplained money or bullion, etc. Unexplained investments, unexplained expenditures, investments not fully recorded. And the last point, amount borrowed or repaid on hundi otherwise than through account paid check. What is that language given? Amount borrowed or repaid on hundi otherwise than through account paid check. Now hundi doesn't mean a temple hundi boss. Hundi basically refers to, hundi is a negotiable instrument. Hundi is nothing but a bill of exchange which is drawn in a local language. If a bill of exchange is drawn in a local language, that bill of exchange is known as hundi. So hundi is nothing but a bill of exchange drawn in local language. So if any amount is borrowed or repaid otherwise than through account paid check, that means if Shivateja is taking a loan, let us say of 10 lakh rupees from my friend Raviteja. If Shivateja is taking loan of 10 lakh rupees from my friend Raviteja, I should take that 10 lakh rupees loan from my friend only by account paid check or maybe online transfer, but I cannot take by way of cash. And I'm sure you know what is the meaning of this word called account paid check. Practically we say that account paid check is a case where two lines are drawn and in between we write the word account pay. In a case of account paid check, that account paid check cannot be transferred to somebody and the money will directly go into bank account. You cannot withdraw the cash against the account paid check. If you have to withdraw the cash, that check is called bearer check. Account pay check, money will directly go to bank account and the check cannot be transferred to a third party. So if you borrow or repay money on hundi, you have to do it only by way of account paid check. But if you do it by way of cash, so for example, if Shiva Teja takes 10 lakh rupees loan by way of cash, and that is loan is on hundi, that is on bill of exchange drawn in local language, done, then Shiva Teja has done a violation of law and I am required to pay tax at the rate of 60% plus surcharge 25% plus cess 4%, effective rate 78%. So in all these cases given under 115 BBE, the tax rate is 78%. And the cases are, what my dear friends? Unexplained cash credit, unexplained money, bullion, gold, unexplained expenditure, unexplained investments, investment not fully recorded, amount borrowed or repaid on hundi otherwise than through account paid check. We are done with discussion about two interesting tax rates, that is section 115 BB and section 115 BBE. 115 BB talks about tax rates on casual incomes like betting, gambling, lottery, crossword puzzles, card games, horse race or any other games of any sort, where the tax rate is flat 30%. But the other side, if you look at, you might ask, in 30% is there surcharge concept, sir? The surcharge will depend upon case specific, which case specific we will talk separately. But 115 BBE, where there is mandatory surcharge of 25% plus cess 4%, basic tax rate 60% there, and the effective rate is 78% in 115 BBE. And what is covered in 115 BBE is unexplained cash credit, unexplained money or bullion or gold, unexplained investments, investment not fully recorded, unexplained expenditures, amount borrowed or repaid on hundi otherwise than through account paid check. Hundi is nothing but a bill of exchange or a negotiable instrument. In fact, that was very popular once upon a time, where it was a hundi bill of exchange, where they used to put one revenue stamp and create one bill of exchange. Against that, they used to take loans and repay the loans. So these are the two interesting tax rate what we discussed till now. That is section 115 BB and section 115 BBE. Now that we are done with interesting discussion about two special tax rate, let me also discuss two more interesting special tax rates in this basic concepts itself, so that we can discuss some brilliant questions. But we can discuss brilliant questions subject to discussion about the basic slab rate tax also. But prior to that, let me discuss something interesting. Friends, let me tell you some interesting concept about how do we calculate tax in case of capital gains. Now, what is capital gains? Already I told you, my dear friends, we know that capital gain is what we get, gain on sale of an asset. For example, there is a building, that building is sold. When the building is sold, there is some gain what the assessee has got. On that gain, how do we calculate the tax? That is nothing but capital gain. Sometime back I already discussed with you that under income tax law, we have got 5 heads of income. The 5 heads of income are salary, house property, PGBP, capital gains, other sources. And all 5 heads of income combined together, we will call it as what? Gross total income. From gross total income, we will reduce deductions under chapter 6A. Then what we get is total income. On that total income, we will calculate tax. Correct? Exactly. So now, in that capital gain story what I was talking about, there is something called long-term capital gain, short-term capital gain. Now, what is long-term capital gain? What is short-term capital gain? When do you call it long-term? When do you call it short-term? We will talk in detail when we go to the capital gains chapter. But let me tell you, generally, when the asset is held for more than 12 months, we will call it as long-term. And in some cases, it is 24 months. Some cases, it is 36 months. Which case 12 months, which case 24 months, which case 36 months, we will talk in detail when I go to the topic of income from capital gain. But now, the objective is to discuss what is the tax rate for that capital gain. Because in the basic concepts, we are trying to understand how do we calculate tax. So let me talk about how do we calculate tax rate in case of capital gains. And as I told you, in capital gains, there is something called long term, there is something called short term. And for long term capital gains, the tax rate is different. And for short term capital gains, the tax rate is different. Now listen carefully, friends. In case of long term capital gains, the general rate is 20%. And that is given by section 112. So for example, one person purchased a property 10 years back and he sold it now and he got a long-term capital gain, let us say of 20 lakh rupees. On that 20 lakhs, he has to pay tax at the rate of 20%, which will work out to 4 lakh rupees. So for long-term capital gains, the general rate is 20%, which is given by section 112. But there is one special case in long-term capital gain, which is extremely important and very, very powerful concept. High probability that question will come in the examination. Listen very clearly, guys. Long-term capital gains on sale of equity shares or units of equity-oriented mutual fund, units of equity-oriented mutual fund or units of business trust through recognized stock exchange on which STT, that is nothing but securities transaction tax, is paid shall be taxable at the rate of 10%, that too 10% on amount exceeding 1 lakh. So if the capital gain is 1,20,000, tax will come only on 20,000, and this 1 lakh is not per transaction limit, this is yearly limit. So if the long-term capital gain on these equity shares and all where securities transaction tax is paid, if it is only 60,000, there is no tax at all. But if it is 1,30,000, we have to pay tax at 10% only on 30,000. So let me repeat section 112A, my dear friends. Long-term capital gains on sale of equity shares. We know what is equity shares, right? Yes. Long-term capital on sale of equity shares or units of equity-oriented mutual fund. Now, what is equity-oriented mutual fund? First of all, let us understand what is mutual fund. Then we will understand what is equity-oriented mutual fund. Now, when I ask you what is mutual fund, don't tell that standard TV dialogue saying that mutual fund is subject to market risk. Read all documents carefully. No, don't say that. Mutual fund is nothing but a collective investment scheme where one person has got knowledge, wherein if he puts the money at one particular company, he knows that he will get profits. And there are different people who are ready to act as investors, but they do not have knowledge where to put that money. So one person, let us say Mr. X, he will create one mutual fund. He will collect money from different people, and that money he will invest somewhere in another company. So from some other company where he invested, if he get profit, he will give profit to all the people. If he get loss, he will give loss to all the people. That is why we say mutual fund is subject to market risk, because mutual fund money has gone to the stock market. Correct, guys? Now this mutual fund, whenever they take money from the public, they don't give shares to the public, because mutual fund is not doing business with that money. They are doing investment activity. So mutual fund gives units to the public who is investing money in mutual fund. That is why we say units of mutual fund. In case of equity, we use the word shares, but in mutual fund, we don't use the word share, we use the word units of mutual fund. But here the language used is long-term capital gain on sale of equity shares or units of equity-oriented mutual fund. Now, what is a equity-oriented mutual fund? There are two possibilities. How do we classify as equity-oriented mutual fund? Possibility number one, a mutual fund which invests at least 65% of the total proceeds what they get. So for example, if they got 10 crores, out of 10 crores, 6.5 crores, that is what we are talking about, which invest at least 65% in equity shares of domestic company. Then we call this mutual fund as equity-oriented mutual fund. You might ask, sir, what will you call if it is less than 65%? Then we will not call it as equity-oriented mutual fund. We will call it as debt-oriented mutual fund. So let's take an example here. Assume for a second there is a mutual fund which totally collected 10 crores from the public at large. And this mutual fund, 7 crores out of that 10 crores, they invested in equity shares of domestic company. So how much percent has gone into equity shares? 70% has gone into equity shares of domestic company. So if a mutual fund invests at least 65% in equity shares of domestic company, then we will regard that mutual fund as equity oriented mutual fund. This is first possibility. There is one more possibility also of equity oriented mutual fund, that is a mutual fund. A mutual fund is investing in another mutual fund, and this another mutual fund is investing in equity shares. In that case, they told percentage is not 65%, percentage is 90%. That means the first mutual fund should invest at least 90% of the total proceeds in another mutual fund, and that another mutual fund should again invest at least 90% in equity shares of domestic company. Then we will regard the first mutual fund as equity oriented mutual fund. So for example, there is mutual fund A. Mutual fund A has got 100 rupees. Out of 100 rupees, at least 90 rupees they have to put in mutual fund B. And in mutual fund B again should at least 90% put in equity shares of domestic company. Then we will regard mutual fund A as equity oriented mutual fund. Mutual fund B is anyways equity oriented because at least 65% they directly put in equity shares of domestic company. So there are two ways how a mutual fund can be regarded as a equity oriented mutual fund. Possibility number one, that mutual fund is directly investing in equity shares of domestic company at least 65%. Second possibility, mutual fund is investing in another mutual fund at least 90% of total proceeds, and that mutual fund is further investing at least 90% into equity shares of domestic companies. Then coming back to the discussion, what is that we discussed? Long-term capital gain on sale of equity shares or units of equity oriented mutual fund. Now I'm sure we understood what is equity oriented mutual fund. So long-term capital gain on sale of equity shares or units of equity oriented mutual fund or units of business trust. Business trust is nothing but a trust is like an association which has been formed where they pull up money from public at large, and that money whatever they pulled they invest into another asset. Something like practically there is something called real estate investment trust, wherein the trust is created. Trust will pool money from the people and they will put the money into one real estate property, and whatever rental income is coming or income is coming to the trust, they will distribute it or to all the unit holders. So this kind of trust are called business trust. So there is a unit of business trust is what we are talking about. So long-term capital gain on sale of equity shares or units of equity oriented mutual fund or units of business trust through recognized stock exchange. That means the shares and all are sold through recognized stock exchange. They are not sold outside somewhere. They are sold only through recognized stock exchange. And the practical example for recognized stock exchange is Bombay Stock Exchange, National Stock Exchange. You're getting my point, friends? So coming back to the point, long-term capital gain on sale of equity shares or units of equity oriented mutual fund or units of business trust through recognized stock exchange on which STT is paid. STT is nothing but securities transaction tax. So whenever we are doing some transaction on stock exchange, we are required to pay something called securities transaction tax, and that is generally 0.01%, and in different case we have got different rate. We need not learn the rates of STT as such, but this section 112A will come into picture only when transaction is done through recognized stock exchange and STT is paid. And practically, my dear friends, when you do a transaction through recognized stock exchange, STT is obvious. It is automatically deducted. And they told one interesting point, in case of equity shares, STT should have been paid at the time of purchase also, at the time of sale also. And in case of equity oriented mutual fund units and in case of units of business trust, if STT is paid at the time of sale, that is enough for this section to apply. You're getting my point, my dear friends? Exactly. So for equity shares, this section will apply only when STT is paid at the time of purchase and at the time of sale. But for units of equity oriented mutual fund, units of business trust, if STT is paid at the time of sale, that is enough. Still section 112A will apply. You might ask one question now, sir, what if equity shares are sold outside the stock exchange? Will this section apply? Answer is no. Then you will go back to which section? We'll go back to section 112, general rate for long-term capital gain, where the tax rate is 20%. But in 112A, it is only 10%. That too 10% on amount exceeding 1 lakh. So let me repeat once again, section 112A. 112 capital A, long-term capital gains on sale of equity shares or units of equity-oriented mutual fund or units of business trust through recognized stock exchange on which STT is paid, that is securities transaction tax is paid, is taxable at the rate of 10% on amount exceeding 1 lakh. This 10% is the tax rate flat, and on amount exceeding 1 lakh, this 1 lakh is not per transaction limit, it is yearly limit. So my dear friends, let's take 1-2 examples of this. Imagine Shivateja purchased shares of Reliance Industries on stock exchange. Then I sold that shares, let us say after 1-2 years, and I got long-term capital gain. In the whole year, that is the only long-term capital gain what I got. And the long-term capital gain what I got is, let us say 80,000. Then the tax will be 0. And next situation, let us say the long-term capital gain what I got is 1,10,000. Law is telling, please pay tax only on 10,000. And that too at the rate of only 10%, boss. Very small percentage. But assume this is not long-term capital gain on sale of Reliance share, but assume for a second this is long-term capital gain on sale of equity shares of PQR Private Limited, a private company which is not through stock exchange, and I got long-term capital gain of, let us say, 80,000. Law is telling on 80,000 pay tax at the rate of 20%. And what if I get 1,10,000? On 1,10,000 pay tax at the rate of 20%. So the story of 10%, the story of 1 lakh will come into picture only in case of section 112A. And 112A will come into picture only in case of long-term capital gains on sale of equity shares or units of equity-oriented mutual fund or units of business trust through recognized stock exchange on which STT is paid. Only in this particular special case only we will tax at the rate of 10% on amount exceeding 1 lakh. So with respect to capital gains, the two sections we discuss now are section 112 and section 112A. 112A is very specific. So if something is not covered in 112A, then what will apply is 112. So if there is a long-term capital gain on sale of building, then 112A cannot apply. What will apply is 112 general rate 20%. Because 112 capital A will apply only if there is a long-term capital gains on sale of equity shares or units of equity-oriented mutual fund or units of business trust through recognized stock exchange on which STT is paid. Then only this section will apply. And that too the tax rate is just 10% on amount exceeding 1 lakh. Now my dear friends, let me discuss one special point. Same situation, that is capital gain on sale of equity shares or units of equity-oriented mutual fund or units of business trust through recognized stock exchange, STT is paid. Same situation, if it is not long-term but it is short-term, then law told it is taxable at a straight rate of, that is flat rate of 15%, 15% as per section 111A. In short, we say 111A. This is 112A, that is 111A. So in 112A, the tax is 10%, that too on amount exceeding 1 lakh. In 111A, the tax is 15%, and there is no concept called 1 lakh. Even if it is 1,000, still pay tax at the rate of 15%. You are getting my point, everybody? And short term, any other short term other than that equity shares, mutual fund and business trust, any other short term is taxable at normal rates. Now what are normal rates? We will talk in detail very soon. Because for individual, the normal rate is different. For partnership firm, normal rate is different. For companies, the normal rate is different. Which case, what is the normal rate? We will talk in detail separately. Clear, my dear friends? Exactly. So friends, come on, let's revise once. So long-term capital gains, what is the general rate? 20%. But if there is a long-term capital gain on sale of equity shares or units of equity-oriented mutual fund or units of business trust through recognized stock exchange on which STT is paid, we will tax at the rate of 10% on amount exceeding 1 lakh. Same scenario but not long term but it is short term. It is taxable at 15% as per section 111A. Any other short term capital gains, normal rate. When I say normal rate, there is no section number for it because normal rates are given by Finance Act. Already I told you. So the three sections what we spoke in this topic are with respect to capital gain are 112, 112A, 111A. 112 general rate for LTCG 20%, 112A LTCG that is long term capital gain on sale of equity shares or units of equity oriented mutual fund or units of business trust through recognized stock exchange on which STT is paid. We will tax at the rate of 10% on amount exceeding 1 lakh. Section 112A. Same scenario, not long term but short term, we will tax at the rate of 15% on amount exceeding 0. There is no concept of 1 lakh as such. And any other short term capital gains, we will tax at normal rate. So let's take one examples here. So let us say there is a sale of building and there is a long term capital gain of 50,000. What tax will come? On 50,000, straight 20% tax, section 112. What if it is not long term but it is short term? We will apply slab rates. What is that slab rate? We will talk in detail. We will call it as normal rates. For individual it is different, for company is different, partnership firm is different. Next, if there is a capital gain on sale of equity shares, STT is paid and it is long term, then what is the tax rate? 10% on amount exceeding 1 lakh. What if it is short term? Then the tax rate is straight 15% and there is no concept of 1 lakh. And the 15% concept is given by section 111A and long term 112A. Long term general rate section 112. Once let us revise the tax rates in special sections what we discuss now. We spoke about 3-4 interesting sections, that is section 115BB, 115BBE, 112, 112A, 111A. So what is 115BB friends? 115BB talks about tax rate on casual incomes like betting, gambling, lottery, horse race, crossword puzzles, car games or any other games of any sort where the tax rate is straight away 30%. What is 115BBE? In case of unexplained cash credit, unexplained expenditures, unexplained money, unexplained investments, investment not fully recorded, amount borrowed or repaid on hundi otherwise than through account pay check, the tax rate is flat 60% plus surcharge 25% plus HEC 4%. Effective rate is 78% because surcharge is a percentage on tax, HEC is a percentage on tax plus surcharge. Then coming back to capital gain special rates, 112 LTCG general rate 20%, 112A LTCG on sale of equity shares or units of equity oriented mutual fund or units of business trust through recognized stock exchange on which STT is paid. We will tax at the rate of 10% on amount exceeding 1 lakh. Same scenario, not long term but short term, we will tax at the rate of 15% and that is given by 111A. Long term 112A, long term general rate 112. These are all the section numbers which are given in the Income Tax Act itself. Now let me discuss two interesting small sections guys. There is something called 288A and 288B which deals with the concept of rounding off of income, rounding off of tax. When I say income, I am not talking about gross total income, I am talking about total income which comes after reducing the deductions. So if income is let us say 6,40,464, then law is telling please make it as 6,40,460. If it is 6,40,466, make it as 470. 465, still make it as 470. So 5 and above, the last number is 5 and above, take it to next 0. If it is less than 5, take it to previous 0. 288A says the total income shall be rounded off to nearest multiple of 10 rupees. And 288B says that final tax payable, the net tax payable is also rounded off to nearest multiple of 10 rupees. So 288A talks about rounding off of income. 288B talks about rounding off of tax. And whether it is income or it is tax, it is rounded off to nearest multiple of 10 rupees. Small point, but still you should know very clearly.